Investing wisely is a key strategy for building long-term wealth. Among the many strategies available, dollar cost averaging, or DCA, has emerged as one of the most widely recommended techniques for both beginners and seasoned investors. While the concept itself is simple, its application can have profound effects on an investor's overall returns. This article will provide a comprehensive explanation of how DCA works, why it matters, and how it can fit into an investment strategy that mitigates risk while maximizing potential growth. Understanding dollar cost averaging. Dollar cost averaging is an investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the asset's price. Whether the market is up or down, the investor continues to make consistent investments, purchasing more shares when prices are low and fewer shares when prices are high. This strategy aims to reduce the impact of volatility by spreading out the purchase over time, ensuring that the investor does not try to time the market, which can be risky and often counterproductive. The basic premise behind DCA is the belief that over time, the market will experience fluctuations. By investing a set amount regularly, investors are essentially buying at different prices, thus averaging the cost of their purchases over time. This strategy is especially valuable during periods of high market volatility, as it avoids the emotional temptation to buy during market peaks or sell during market dips. The power of regular investing. One of the most compelling aspects of DCA is that it takes the guesswork out of investing. Rather than attempting to predict the best time to enter the market, investors who use DCA simply invest consistently. This allows investors to focus on their long-term goals rather than short-term market movements. It can also help mitigate the risk of making large, poorly timed investments that can negatively affect the overall performance of a portfolio. Additionally, regular investing through DCA encourages a disciplined approach to investing. By committing to a set schedule and sticking to it, investors avoid making decisions based on short-term market movements or emotions. This is particularly important in the world of investing, where psychological factors such as fear and greed can lead to poor decision-making. How dollar cost averaging works in practice. To better understand how DCA works in practice, let's break down a typical example. Suppose an investor decides to invest $1,000 every month into an index fund over the course of 12 months. The price of the index fund fluctuates every month, so the number of shares the investor buys each month will vary. For example, if the price per share in month 1 is $50, the investor will buy 20 shares. If the price increases to $60 per share in month 2, the investor will purchase 16.67 shares. In month 3, if the price drops to $40 per share, the investor will buy 25 shares. At the end of the 12 months, the investor will have purchased a total of 250 shares at varying prices. The average cost per share will depend on the fluctuations of the market during that period. This approach ensures that the investor is not overly exposed to the risk of buying at a market peak, nor are they trying to time the market in order to maximize returns. Over the long term, DCA can help smooth out the volatility of the market, especially for investments in volatile assets such as stocks. The benefits of dollar cost averaging. 1. Reduced impact of market volatility. One of the key benefits of DCA is its ability to reduce the impact of market volatility. By investing consistently over time, investors avoid putting all of their money into the market at a single point in time when prices could be higher than average. This makes DCA an effective strategy for mitigating the risks associated with sudden price swings and erratic market movements. 2. Disciplined approach to investing. Dollar cost averaging promotes discipline by encouraging investors to stick to a regular investment schedule. This approach eliminates the temptation to act on short-term emotions, such as fear during market downturns or greed during market booms. By committing to a set investment schedule, DCA encourages investors to stay focused on their long-term goals, which is essential for building wealth over time. 3. Simplicity and ease of use. Dollar cost averaging is simple to implement and does not require extensive market knowledge or expertise. By automatically investing a fixed amount on a regular schedule, investors can avoid the complexity of trying to time the market or research which investments to purchase. This makes DCA particularly useful for beginners, as it provides a straightforward, low-maintenance investment strategy. 4. Avoiding the pitfalls of market timing. Market timing, attempting to buy at the lowest price and sell at the highest, is extremely difficult to master, even for professional investors. DCA allows investors to avoid the temptation to time the market. Instead of worrying about whether it's the right time to invest, DCA allows investors to invest continuously, removing the stress of decision-making during periods of market uncertainty. When to use dollar cost averaging. While DCA is an effective strategy in many situations, it's important to recognize when it is most appropriate. DCA is especially beneficial in volatile markets or when an investor is just starting out and has limited funds to invest. It allows new investors to enter the market without the pressure of having to time their investments perfectly. DCA is also useful for investors who are looking to invest for the long term and are not concerned with short-term fluctuations. For example, if an investor is saving for retirement 20 or 30 years down the road, using DCA to make regular contributions to their retirement account is a low-risk, effective strategy to accumulate wealth. Limitations of dollar cost averaging. While dollar cost averaging offers many benefits, it is not without its limitations. One of the main disadvantages is that DCA does not guarantee profits, and it can still result in poor performance if the market declines over the long term. If an investor is using DCA in a market that experiences a prolonged downturn, the value of their investments may decrease significantly. Why dollar cost averaging matters. Dollar cost averaging matters because it aligns with the principles of long-term investing. By committing to regular, consistent investments, investors are more likely to stay disciplined and focused on their financial goals. DCA helps avoid the psychological pitfalls of trying to time the market and prevents emotional decision-making, which can often lead to poor investment outcomes. By using DCA, investors can ensure they are consistently contributing to their financial goals, avoiding the temptation to chase market trends and benefiting from the power of compound interest over time. Whether you're a beginner or an experienced investor, incorporating dollar cost averaging into your investment strategy can help you achieve financial success while minimizing risk and uncertainty.